So I had this kind of crazy idea. What if you could automate Warren Buffett's investing brain? Take all his wisdom, all his rules, and turn them into pure Python code. Well, I actually did it. I built the Buffett bot. And what it found was frankly shocking. I unleashed it on the entire S&P 500, and you're not going to believe how many companies it just threw in the trash. 492. Seriously, out of the 500 biggest, most respected companies in America, my script rejected 492 of them. It was a complete bloodbath. This little bot was absolutely ruthless. And that's the multi-billion-dollar question, isn't it? After all that carnage, only 9 companies were left standing. Stick with me because I am going to show you exactly which 9 companies survived this brutal, data-driven test. And trust me, the results are probably not what you're thinking. Look, let's just be real for a second. Guys like Warren Buffett have a massive, almost unfair advantage. The man literally spends 8 hours a day just reading annual reports to find one good idea. I'm a software engineer. I've got a job. I've got a life. You have a job. You have a life. We just don't have that kind of time. And that's the exact problem we're trying to solve here. And I'll be the first to admit, I've been there. I used to lose money chasing stories. The latest AI hype, the next big energy play. I bought the narrative, not the actual business. And wow, I paid for that lesson in real dollars. Most people don't lose money because they're stupid. They lose money because they don't have a disciplined, unemotional set of rules. That was a mistake that cost me, and it's one I am never making again. So to fix this, I decided to take opinion and emotion completely out of the equation. This whole analysis, it's not based on feelings or hype. It's built on facts. This is not an opinion. I fetched real historical data and ran calculations on that data. So there are no assumptions, just calculation, upon which you can rely. Just cold, hard math. Okay, so this brings us to the heart of the project. I took Buffett's core philosophy, his ideas on cash flow, on strong balance sheets, on pricing power, and I translated all of it into a Python script. A system built on 4 simple but absolutely non-negotiable rules. And this was the big question I wanted to answer. Can discipline be automated? Because if it can, that means we can remove the single most expensive mistake any of us ever make as investors: emotion. This script, this Buffett bot, it's my attempt to answer that question. Let's break down the rules. All right, first up, rule number 1, the cash engine. Buffett likes to call this a company's moat. In the world of finance, it's called return on invested capital, or ROIC, and my code demands a ridiculously high 25%. Why so strict? Because only the truly elite businesses can consistently make that much profit. It's a pure measure of efficiency. I mean, if a company can't make a great return on the money it already has, why on earth would I give them any of mine? Now, let's talk about rule number 2, the safety score. Debt is like a performance-enhancing drug for a company. It makes growth look incredible, right up until the economy hiccups, and then it becomes a giant anchor pulling the whole ship down. When I was working as a fintech engineer at a hedge fund, this is exactly how we calculated risk. We looked at the debt first. So my script calculates a safety score. If a company owes way more than it's worth, the bot flags it as fragile and just moves on, no exceptions. Next up, rule number 3, and this one is so important. I call it the lie detector. You see, the profit a company reports, its net income, that's kind of like an opinion, but free cash flow, that's a fact. That's the actual, real cash piling up in the company's bank account. My code compares the two. If a company says it's making billions, but its bank account is empty, the bot immediately flags it as suspicious and kicks it out. And finally, rule number 4, which might be the most crucial of all, the price check. Because listen, even the most amazing business in the world is a terrible investment if you overpay for it. So my system only gives a green light to companies that are in a fair or even a bargain valuation zone. This is what Buffett calls a margin of safety. And that right there is the difference between professional investing and just gambling. Now, if you're not a coder, don't worry. You don't need to know Python to get the logic here. But for all my fellow developers watching, I wanted you to see this. There's no magical black box AI stuff happening. It's just 200 lines of clean, disciplined filters. It's a totally transparent system based on first principles. And this is the real power of automation. If you or I tried to do this by hand, analyzing the financial statements for 500 companies, it would take months of full-time work. My script, it does the entire thing in 42 seconds. That's the power we're unlocking with code. Okay, so we've got our rules. They're hard-coded and ready to go. Now,
Now for the fun part. We're about to unleash the Buffett bot on the entire S&P 500. Let's see who survives.
First up on the chopping block, a huge fan favorite, Tesla. The script took one look at the numbers and nope, rejected. And the reason was simple, a weak moat. The profit margins are just too thin to meet that super strict 25% ROIC rule. The math just doesn't support the hype.
Okay, so what about the absolute darling of the AI boom, Nvidia? Rejected. Two big reasons here. First, it failed the price check. It's just way too expensive right now. There's no margin of safety. And second, it got flagged for poor cash quality. The lie detector wasn't happy with the difference between its reported profits and its actual cash flow. And this is what's so beautiful about this approach. This system doesn't care about a CEO's Twitter feed. It doesn't care what's trending on Reddit or what the experts on TV are yelling about. It has zero feelings, zero bias. It only, and I mean only, cares about the math. Let's just visualize how brutal this is. This is what the S&P 500 looks like after the Buffett bot gets done with it. A full 98% of the market gets rejected, just tossed aside. Only this tiny 2% sliver makes it through. This is what true investing discipline looks like. It's quiet, it's boring, and it is absolutely merciless.
Which brings us to the moment you've been waiting for. We have purged the market of the weak, the fragile, and the ridiculously overpriced. So now, let's meet the champions, the 9 elite survivors that actually made it through this gauntlet. So, after all that, after the smoke cleared, after 492 companies were rejected for failing one or more of our 4 critical tests, only these 9 companies were left standing. You ready for this? Here they are, the 9 survivors. We've got Align Technology, the company behind Invisalign, Decker's Outdoor, who makes Hoka and UGG, F5, a software company, EOG Resources, an energy player, Airbnb, which you all know, Lululemon, Snap-on, the tool company, ON Semiconductor, and Altria Group. Wow, that is a pretty diverse list, and I'll bet it's not what most people would have guessed. So what makes these companies so special? Why did they pass? Let's look at the data. Take Align Technology. It had a return on invested capital, our cash engine rule, of over 200%. That is just a phenomenal number. It tells you this business is an absolute cash-generating machine. And what about their safety? Their balance sheets are like Fort Knox. A company like Snap-on, for instance, scored a 95 out of 100 on our safety score. That means it has extremely low debt and is built to be incredibly resilient. These are companies that can weather just about any economic storm. Now look, seeing this list is really interesting, but my goal here isn't to just hand you a list of stocks. It's to show you the process. It's all about empowering you to build your own filter, your own disciplined, unemotional system. And you can totally do this yourself. It really just boils down to these 4 steps. 1, demand a cash engine. Look for those high, consistent returns. 2, check the safety score. Avoid companies that are drowning in debt. 3, use the lie detector. Make sure the cash flow matches the hype. And 4, wait for a fair price. Never, ever overpay. And I want to be crystal clear about why I'm doing this. I am showing you this calculation to teach you how to analyze markets like a professional, like a hedge fund, so you can make your own decisions. This code is a filter. It's a tool. It's not a crystal ball. I'm not some guru, I'm just a builder. And as a builder, I believe in testing ideas, not just blindly following them. So to prove this is all real, I've made the entire project open source. You can download my Python scanner and this dashboard from my GitHub right now and run it yourself. The link is down in the description. Go ahead, tweak the rules, run it on your own watch list. At the end of the day, it really just comes down to this. If you want a quick dopamine hit from the market, go ahead, follow the hype, chase the next big story. But if you actually want results, you have to follow the math. So, what should I build next? Do you want to see the Buffett bot scan the European market? Or maybe a deep dive into exactly why a giant like Amazon failed the fast? Let me know what you want to see down in the comments below. I read all of them. I'll see you in the next build.